The cost of goods sold refers to the amount of the goods that you are selling. Okay? And in particular, we are talking about the cost. So that's why whenever we are selling the goods, that will be reduced from our inventory account. And then, if you have a beginning balance, you are going to add that as well. And your final number will be your ending balance. Okay, so we are going to use this equation for a few times along or whenever we talk about inventory. So once again, now we know how much we should include as part of the cost on the day of the acquisition. So now, what about, say, at the end of the month or at the end of the year? Do we have to make some adjustment to the value of the inventory on our financial position statements or statement of the financial position? Okay, so similar to last class, whenever we were talking about temporary investments, we would have to adjust the value so that it is the market value at the end of the year. So it's very similar for inventory. We also have to make some adjustments so that it is reflecting our current market value. But there is one more step that we need to do for inventory. So first of all, as you can see, inventory is valued at the lower of the cost and the net realizable value. So the lower of the two. So what you have to do is you will have to come up with the cost, which is your original purchase price, which is the thing that we talked about 2 slides ago, as well as the net realizable value. So you compare the two, and then take the low of the two. But which one is lower, you take that one. And then that will be recorded on the balance sheet. Okay. So it's similar to temporary investment, but not exactly the same, because for temporary investment, we must take the market value, no matter whether the market value is higher or lower than our book value. But in this case, it depends. We are going to take the lower of the two numbers. Okay, so we know what is the cost, but what does it mean by the net realizable value? So net realizable value refers to the estimated selling price. Okay, estimated selling price means you expect that will be the sales price. So for example, you want to sell the pen at, say, $2. So that will be your estimated selling price. But it may turn out to be only $1.50 because you can only sell it when it's on sale. Okay? But we don't really care about that. We only care about the price that we want to sell at, estimated selling price. And then minus the cost that is necessary to sell the inventory. So for example, if you have to pay commission fee to your salesperson in order to sell a product, that would be part of the cost to sell the product. So any selling expenses, any commission fees that you have to pay, that will be deducted from the estimated selling price. So now you know the definition of the cost, and you know the definition of the net realizable value. So we just have to take the two, compare the two, and then take the lower of the two. Okay. So any questions about that? That must be done at the end of the period. So now, in terms of recognition of the expense and the revenue, we have done that already for many, many times. When you sell the goods, you are able to recognize the revenue, and at the same time, by the matching concept, you must recognize the expense, which is the cost of goods sold. Okay, so nothing new for that point over there. Okay. So now, we know how to deal with the cost on the acquisition date. And we also know how to deal with the lower of the cost and the net realizable value on any subsequent measurements. Okay. Our next step here is our valuation. So that is, how do we record the inventory cost? And exactly how often do we record the inventory cost? Okay. Because ideally, a company should be able to keep track of every single purchase and every single sale of the inventory. So that is, whenever you sell something to your customers, you should update your computer system so that you have the most up-to-date record. That is the ideal situation. But if you think about a very, very small retail or grocery store, maybe it doesn't even have a computer. Okay. Nowadays, it should, but maybe not. Okay. So what they are going to do is they may not have the most up-to-date record of how much inventory they have. Okay. So something like this would refers to whether they are using periodic inventory system or perpetual inventory system. So for periodic inventory system, the first one, the record is only updated maybe once a month, once every 6 months, or every year. But for perpetual inventory system, the record keeps updated every single second. So for example, whenever there's a sale, the computer will update the record. Okay, so you can easily see that the perpetual inventory system is much better than the periodic system. But on the other hand, the perpetual inventory system would be more costly than the other one. Okay. So let's go into the periodic system and the perpetual system in more details. So for periodic system, so that is the one we only update every single month or every single half a year. Okay. So we would only update, for example, the inventory, how much inventory we have, as well as the purchase, as well as the cost of goods sold at the end of a certain period. Okay. So what that means is, at the time of the sale, whenever you sell something to your customers, you wouldn't know by your record that the inventory has been reduced. Your inventory will still stay at the previous level, and it will only be reduced at the end of the month. Okay, so that is periodic inventory system. So now, by the end of the month or by the end of the year, how do you know how much inventory you have? Is by taking a physical count. So you would have to go to your warehouse or go to your store to see how much inventory you have. By performing the count, you will know the ending balance of the inventory. And given that you know the ending balance of the inventory, and by the fact that you must also know the beginning balance, which is from the previous year, as well as any purchases that you made, then you will be able to calculate your cost of goods sold. So what that means is, under the periodic system, you will only know the cost of goods sold whenever you perform the physical count. Okay, so that is the drawback of this periodic system here. And as you can see, this equation is the one that we just talked about, but we are just rearranging the items by a little bit, so that we are solving for the cost of goods sold rather than solving for the ending inventory. So any questions regarding the periodic inventory system? Okay. So for the perpetual, it's much better than a periodic system, because whenever we sell a product, we are going to scan it, for example, and then our record will be updated. Okay. So that is the perpetual inventory system. So in this case, at every single second, you will know how much inventory you have, and you also know how much cost of goods sold you have. Okay, so that would be the advantage of using the system here. But you can also see that we still have to perform the physical count. It's not that we don't have to perform the physical count. And the reason why we have to perform the physical count in this case is because we want to detect any spoilage or theft or things like that. Okay. So if you think about the perpetual inventory system, at the end of the month, your computer system should have the most up-to-date record. For example, $1,000. It shows that you have $1,000 for the ending inventory. But now, when you go into your warehouse and then perform the physical count, you only have $900 left of inventory. Okay. So why is that the case? It should be because the $100 is due to, for example, spoilage or theft of the inventory. Okay. So now you're able to detect those stuff by using the perpetual inventory system. But by using the periodic inventory system, even by the physical count, you will not be able to detect theft or spoilage, because you don't know what is the right ending balance, because you don't have the computer record. All you have is the physical count record, and that will be your ending balance. Okay. So that will be the differences between the periodic system and the perpetual system. Any questions? Okay. So now it's just giving you a summary of the two systems. And it's just what we just talked about to identify inventory shrinkage or theft. and the perpetual inventory system is much more costly. So which one to use really depends on the needs of the company. IFRS doesn't really specify which one to use. It's up to the company to determine which one to use. Okay, so every single company should determine the cost and benefit. So whether the cost is going to exceed the benefit or not. If the cost is higher, then maybe it's a better idea to use the periodic system. But if the benefit is higher, then it should be a better idea to use the perpetual system. So that would be the differences between periodic and perpetual system. And now, we want to move one step further, and then to determine how much cost of goods sold should we recognize on our income statement. So usually, you think it's not a problem because we know exactly how much that inventory cost you when you purchase the inventory. But in reality, that may not be the case. Okay, so think about this example here. So consider you purchase two of an identical items at two different times. Okay, at a cost of $10 or $100. That may be a rather extreme case, or you could think about you are selling inventory which is a pen or a marker, and then 1 year ago you purchased a marker that cost you $2.50, and today it costs you $3. Okay, so that is possible because of the inflation, and now because the two markers are identical, you cannot tell which one is which. So when you sell one of the two markers, how do you know whether it's the one that you purchased 1 year ago or is the one that you purchased today? So that is whether the cost of goods sold should be $2.50 or $3. In this case, $10 or $100. But it's the same thing. So how do you determine that? Of course, ideally, you have a computer system and you have a specific barcode or serial number that will tell you whether this pen or marker is the one that you purchased 1 year ago or today. Okay, but imagine you don't have something like that. How will you determine which one to use? Okay, so the answer depends on the cost flow assumption. So we are going to talk about what does it mean by cost flow assumption. But before we get into that, let's talk about the effect on our statement. So for example, if $10 is recorded as the cost of goods sold, so that is, you think you are selling the one that you purchased earlier, then what that means is your ending value would be $100. You still have the one that you purchased recently, $100. But on the other hand, if you think that you are selling the one that you purchased today, $100, so that would be the cost of goods sold, and what you would have in your ending inventory would be the one that you purchased 1 year ago, $10. Okay. So you can see that it makes a big difference because cost of goods sold is an expense on the income statement, and ending inventory is an asset on our balance sheet. Okay. It's going to affect our profitability as well as our liquidity by a significant amount, especially if the price fluctuates a lot. If there isn't too much of an inflation, that is not a very big problem because maybe it's just 1 cent or 2 cents of a difference. But if there is a huge inflation, then that is a problem. Okay. So as you can see, if the prices are consistent, that is, there isn't too much of a fluctuation, then that is not too much of a problem. Okay. So as you can see, the main idea of the cost flow assumption is to allocate the cost or to separate the amount as the cost of goods sold and the ending inventory. Okay. So should we put down $10 as the cost of goods sold or should we put down $10 as the inventory? Okay, so that is the main question that we're going to solve by the use of the cost flow assumption. And in particular in accounting under IFRS, we have 3 different cost flow assumptions that we are able to use. Which one to use again depends on the company itself. And the first one is specific identification. The second one is the first in, first out, or the FIFO. And the third one is the weighted average, or the moving average. Okay, so we are taking the average. So the first one is the easiest, specific identification. So what that means is the product or the inventory that you have has a specific serial number or identification number or a barcode, anything like that. So when you look at that